The Dow just closed at a fresh record high. So why did Japanese stocks fall over 200 points on the very same trading day? Hello everyone, welcome back to AI Market News. In today's explainer, Dow hits new high, Nasdaq rebounds strong. We're looking at the market action for July 7th, 2026, based on available data across the US and Japanese markets. Let's start with the action over in New York. On Monday, July 6th Eastern Time, the Dow Jones Industrial Average rose for a second straight session. As we can see in the chart, it closed up 155.84 points, or 0.29%, ending the day at 53,055.91. That is yet another record close for the index. The move was really driven by all of us watching investors buy back into semiconductor names that had been sold off the previous week around quarter end, but the buying broadened well beyond chips into other tech names, with heavyweights like Apple and Alphabet both moving higher. Elsewhere, we saw IBM gain after an analyst price target upgrade, and industrial and financial names like Boeing and Goldman Sachs also traded up. Moving over to the tech-heavy side, the Nasdaq Composite snapped a two-day losing streak. The graph shows the Nasdaq's solid rebound on the board, closing up 288.49 points, or 1.11%, to settle at 26,121.16. A massive standout here was semiconductor giant AMD, which surged more than 10% intraday after an analyst raised its price target. Broadcom also had a fantastic day, gaining ground after announcing an extension of its chip supply agreement with Apple. This is a clear sign that the market's appetite for AI and semiconductor names remains incredibly strong for all of us following the sector. So what's driving this? The mechanism at work here is fueled by strong US earnings expectations and a renewed enthusiasm for AI infrastructure spending. This optimism acts like a giant magnet, pulling capital right back into semiconductor stocks after a brief pullback. And because these big semiconductor and tech names now make up an outsized share of total market value, when they rally on AI demand, their massive market weight naturally lifts the broader indices with them. It's a classic case of the biggest players pulling the rest of the market up. Now, over in Tokyo, the picture looked very different for Japanese investors. As you can see in the chart capturing the day's action, the Nikkei 225 fell 223.20 points, or 0.56%, to close at 39,587.68. This marks its first decline in 3 sessions. What's particularly notable is that the index actually opened above the previous day's close and briefly traded higher, but as the session wore on, it spent most of the day under significant pressure. Why the disconnect with Wall Street's strength? According to current market information, the answer lies in tariffs. President Trump signed letters notifying somewhere between 12 and 15 trading partners of new tariff rates, with plans to send them out on July 7th. With the deadline for trade negotiations approaching fast, uncertainty over the contents of those letters weighed heavily on risk sentiment in Tokyo. Here is the underlying mechanism. Tariffs act as a tax that increases the cost of imported goods. For companies relying on global supply chains, these higher costs can severely squeeze corporate profit margins. So when tariff uncertainty rises, we see investors naturally protect themselves by trimming their positions in riskier equity assets, preferring to sit on the sidelines and wait for clearer rules of the road. Directing our collective attention to the currency and bond charts, we have a real tug-of-war happening. USDJPY traded in a choppy range throughout the Japanese session, settling around 161.96 in late trading. The yen's fragility near the 162 level continues to be capped by persistent intervention risk. Japanese officials have repeatedly declined to comment on current currency levels, which the markets read as a strong signal that direct currency intervention could happen suddenly, without much warning. And driving that currency dynamic are Treasury yields. The 10-year Treasury yield is currently trading around 4.5%. The fundamental driver here is that when U.S. yields rise, it generally reflects expectations of higher for longer interest rates or concerns about government fiscal expansion. Both of these factors make dollar-denominated assets much more attractive to global investors, which supports the U.S. dollar. However, there's a flip side. Sharply rising yields increase borrowing costs and discount rates, which can threaten the high valuations of equity markets, particularly for growth and tech stocks. Despite these cross-currents, the VIX tracker here reveals something quite reassuring for all of us. The VIX, Wall Street's so-called fear gauge, sits essentially flat on the day at around 15.97. If we look back over the past month, the VIX spiked every 20 in late June before steadily declining. What this signals is that the broader market has grown much more comfortable and is stabilizing, even with the recent macroeconomic headline noise regarding tariffs and currency interventions. Before we close out today's explainer, let's look ahead to the upcoming economic calendar for key indicators that could shift these trends.
On Wednesday, July 8th, the Federal Reserve will release the FOMC meeting minutes. Traders will be dissecting this closely for any shift in tone regarding inflation and the future pace of interest rate moves. Then on Thursday, July 9th, we have weekly jobless claims coming up, looking to see if it deviates from the prior reading of 215,000. That very same day, we'll also get the June existing home sales data, which will give us all a fresh read on the underlying health of the U.S. housing market. Putting it all together, this week's market really is a tale of two forces. On one side, we have resilient U.S. equity strength, driven by AI and semiconductor demand, pushing indices to new highs. On the other side, we have the Japanese market struggling against the headwinds of tariff uncertainty and a fragile yen, shadowed by intervention risks. It's a fascinating tug-of-war that we'll all need to keep a close eye on as we head into the FOMC minutes later this week. So, which of these powerful forces will ultimately dictate the market's true direction heading into the end of the month?
Thanks for watching. Please subscribe and hit the like button.
This video was automatically generated by NotebookLM AI. AI-generated content may include errors. This video does not constitute investment advice. For full details, please check the description below.